Hi everyone, Joe Gentili from Left Tail Risk Advisors. So in today's video, I want to go through why, if you are a wealthy investor, you want life insurance in your life. So let's assume that you're wealthy, you're a high net worth or ultra high net worth investor. You own, as many high net worth people do, you have real estate investments, you may have investments in art, you may have investments in businesses, both public and private. And so most people that are buying life insurance, most middle class folks that are buying life insurance are buying it for the purpose of protecting their loved ones to replace their income. And if you are high net worth or ultra high net worth, you may not have those same concerns that if you pass, your family needs to replace income to make sure that they're okay. But what ultra high net worth and high net worth folks need is they need liquidity. So they may have enough assets that they don't have to worry about taking care of their family, but liquidity is a concern, especially fast liquidity. So for folks that are very wealthy, they may be subject to estate taxes. Federal estate taxes kick in at net worths above $15 million. And for some states, that number can be much lower. For states like, for instance, Massachusetts and Oregon, that could kick in at $1 million or even $2 million of net worth. And estate taxes can be a significant amount of money. The federal estate tax, for instance, could be 40%. That is a lot of cash that folks have to come up with within 9 months of death to satisfy that tax. And so for folks that are invested in assets, what you don't want to have is you don't want to have a situation where they are forced to sell, not on a timeline of their choosing or when market conditions are good, but just when it happens to be that you pass away, and that can create a fire sale, and it can create a lot of drama and a lot of headaches during a period of time where they should be focused on grieving and not focused on how to quickly dispose of assets and which assets to quickly dispose of to satisfy a very large tax obligation. And so life insurance is a tax efficient way to take care of that problem, to ensure that upon your passing, liquidity is there. It's there to take care of that estate tax obligation or any other cash obligations that may exist upon passing. And it's very tax efficient because life insurance proceeds are paid income tax free. And also, if they're held in an irrevocable trust, they're paid estate tax free. So that is very, very tax efficient way to transfer assets to take care of this issue. So in addition to having liquidity upon death to make sure that the family can hold on to the assets and businesses that you've built or collected, or they could dispose of them when they want to, not when they're forced to, you also probably have a lot of illiquidity in your estate. And if you have multiple heirs, you're going to want to have potentially, you're going to want to have those assets divided equally or divided in a particular proportion, such that, let's say you have a business and you want one child that is working in the business to inherit that business, but you want your other children to get an equal inheritance. Life insurance can be a very efficient and elegant way to accomplish that, where instead of imposing putting children into a business, for instance, that they don't work in or may not want to be involved in, and not creating tension about having the working children buy out the children that aren't working. You could have life insurance to provide liquidity where one child inherits the business and the other inherits cash through the policy. So in addition to having liquidity to deal with tax issues, you could also have that life insurance as a way to equalize estates when the assets themselves don't lend themselves to easy equalization. So there's a lot of reasons aside from income that a person that is very wealthy would want life insurance in their life. The more illiquid their assets are, the more complicated their assets are, the more important it is to have liquidity upon death, and life insurance with its very strong tax benefits is usually the most efficient way to deliver that. So if you have any questions, this is obviously a very complex topic. It's a very deep topic. If you have any follow-up questions on this, please feel free to reach out. And if you found this video useful, I encourage you to like and subscribe for future ones. Thanks.